Every major gold bull run in modern history started the exact same way. 4 bull runs, 4 completely different decades, different presidents, different wars, different economies, but underneath all of it, the same signal, every single time. That signal just fired again, in May of 2026, and almost nobody is talking about it. So in the next 14 minutes, I'm going to show you what that signal is, every time it has appeared in the last 55 years, what happened to gold afterward, and why the version firing right now might be the strongest one we've ever recorded. Quick note before we dive in, nothing on this channel is financial advice. We're covering the news, the data, and the history. Everything you watch is for educational purposes only. With that said, here we go. Forget the noise, forget the headlines, forget what your favorite analyst said last week. There is one mechanical, measurable, repeatable signal that has preceded every major gold bull run since the Bretton Woods system collapsed. The Fed pivots from tightening to easing, while inflation stays sticky. That's it. That's the whole signal. Now here's why it matters. When the Federal Reserve raises interest rates, they're trying to slow the economy and cool inflation. Rates go up, money gets more expensive, bonds and savings accounts start paying you real returns. In that environment, gold has competition. Gold pays no interest, no dividends, no yield. So when bonds pay 5 or 6%, gold has to fight for capital. But the moment the Fed reverses course, the moment they start cutting rates, something specific happens. The interest you earn on cash drops, the yield on bonds drops, but the cost of living, the price of food, energy, housing, that doesn't drop at the same speed. It stays sticky. So your real return, what you actually earn after inflation, collapses. And when real returns collapse, gold has no competition. The opportunity cost of holding gold disappears. Capital flows in, the price moves. This isn't a theory, it has happened 4 times. Let's walk through every single one. Run 1, the 1970s. In 1969, the Federal Reserve under William McChesney Martin had been tightening aggressively. The Fed funds rate hit 9%. They were trying to kill the inflation that was already building under Lyndon Johnson's guns and butter spending. Then, in 1970, Arthur Burns took over the Fed, and almost immediately, he started cutting. By March 1971, the Fed funds rate had dropped from 9% to less than 4%. But inflation didn't follow it down. The CPI stayed above 4%. Oil prices were climbing. Wage pressure was building. Real interest rates went negative. And then, on August 15, 1971, Richard Nixon closed the gold window, ended dollar convertibility, and the floodgates opened. Gold went from $35 an ounce, where it had been frozen for 37 years, to over $850 by January 1980. A 24-fold return in a decade. But it didn't start with Nixon closing the gold window. It started with Arthur Burns cutting rates while inflation kept climbing. Everything else just amplified the signal. Run 2. Inside that same decade, because the 70s gave us 2 distinct legs. After the first oil shock in 1973, the Fed under Burns hiked rates again, all the way to 13% by 1974. Inflation was running over 11%. Volcker hadn't taken over yet. Burns was still trying to use rate hikes to slow things down without crushing employment. Then, mid-1974, the US fell into recession. Burns reversed course. The Fed cut rates from 13% down to under 5% over the next 2 years. But inflation? Inflation barely moved. It bottomed at around 5% and started climbing again as the second oil shock hit in 1979. Same signal, Fed cutting, inflation sticky, real rates collapsing. Gold, which had pulled back from $200 to about $103 in 1976, started a new leg. From 1976 to January 1980, it ran from $103 to $850. More than a 7-fold return in 4 years. 2 cycles, same signal, same outcome. Run 3, the 2000s. Different decade, different Fed chair, same signal. In the late 1990s, Alan Greenspan had been hiking rates to cool the dot-com mania. The Fed funds rate hit 6.5% by mid-2000. Then the bubble popped. The Nasdaq lost almost 80% of its value. The Fed panicked. Greenspan started cutting aggressively, from 6.5% down to 1% over the next 3 years. But inflation, measured by the things people actually buy, didn't drop. Oil was climbing, housing was climbing, healthcare and education were climbing at multiples of headline CPI. Real interest rates went negative again, and gold, which had been bottoming around $250 an ounce in 2001, gold that had been called a dead asset for 2 decades, started moving. By 2008, it had crossed 1,000. By 2011, it hit 1,920. A nearly 8-fold return. Same exact signal, Fed pivot to easing, sticky inflation, real rates collapsing, capital flowing into gold. If you're keeping count, that's 3 different decades, 3 different Fed chairs, 3 different economies, and the same mechanical signal. But there's a 4th run, and it's the most important one to understand, because it's the closest analog to what's happening right now. Run 4, the Powell Pivot. December 2018, Jerome Powell, after raising rates 9 times to a target of 2.25% to 2.5%, made his famous autopilot comment about quantitative tightening. The market panicked. The S&P 500 dropped nearly 20%. By January 2019, Powell reversed. By July of that year, the Fed had cut rates for the first time in over a decade. Then they cut again, and again. 3 cuts in 5 months. Inflation stayed near 2% at the Fed's target, but real returns dropped to nearly zero. And then in 2020, when COVID hit, the Fed cut to zero and printed several $1 trillion. Gold, which had been sleeping at $1,200 an ounce in 2018, ran to over $2,070 by August 2020. Now, this one is interesting, because in 2018, the inflation side of the signal was weaker. CPI was only at the target. The real rate collapse came mostly from the cuts themselves, not from sticky inflation, which is why the run only delivered a 70% gain. Strong, but smaller than the others. The bigger the gap between Fed easing and sticky inflation, the bigger the gold move. Hold on to that, because it matters for Run 5. Run 5, May 2026. Let's put the current signal next to the historical ones. The Federal Reserve under Jerome Powell raised the Fed funds rate to 5.5% by mid-2023, the most aggressive tightening cycle since Paul Volcker. Then in September 2024, they started cutting. As of this recording, the Fed funds rate is at 4.35%. 5 rate cuts in 18 months. The market is pricing in another 2 cuts before year-end. So the Fed pivot to easing? Confirmed. Now the inflation side. The latest CPI print, April 2026, came in at 3.8%. That's nearly double the Fed's 2% target. And core CPI, the measure the Fed actually watches, has been stuck above 3% for over a year. So inflation sticky? Confirmed. Now look at real interest rates. The 1-year inflation-adjusted Treasury yield was at positive 3.06% in March of this year. As of last week, it had collapsed to positive 0.35%. That is the fastest collapse in real rates since 1971. And gold? In 2025, gold gained 67%. That's the largest single-year gain since 1979. Spot price right now is sitting between $3,300 and $3,400 an ounce. Every component of the signal is firing, stronger than 2018, stronger than 2000, and in some ways, structurally similar to 1971. So what do the people who study this for a living think happens next? Pierre Lassonde, the founder of Franco-Nevada, one of the most respected voices in the entire mining industry, published a forecast in April 2026 projecting gold at $17,250 an ounce by 2030. ING Bank, $5,000 by 2028. UBS, $5,500 in their stretch scenario. Joe Moglia, former TD Ameritrade CEO, $10,000 in a debt spiral scenario. These aren't gold bug podcasters on YouTube. These are institutional forecasters with billion-dollar reputations on the line. And every single one of them is anchored on the same thesis: Fed easing, sticky inflation, collapsing real rates, currency debasement. The signal, just measured differently. Now here's the part I want you to hold on to. In every previous bull run, gold was riding one engine. In 1971, it was the gold window. In the 70s, it was oil. In the 2000s, it was the dot-com unwind and easy credit. In 2018, it was Fed reversal. Today, gold has every engine running at once. Central banks bought over 1,000 tons of gold in 2024, then over 1,000 tons in 2025. That's the 17th consecutive year of net buying, 16 years in a row at multi-decade highs. The BRICS bloc is settling more cross-border trade outside the dollar system every quarter. U.S. federal debt just crossed $35 trillion. The interest payments on that debt are now larger than the entire defense budget. The dollar's share of global reserves has dropped from 72% in 2000 to under 59% today. So the signal, Fed easing, sticky inflation, collapsing real rates, is firing on top of a structural shift in the global monetary system. That's why analysts are talking 5,000, 7,000, 10,000, 17,000. Not because they're gold bugs, because the math has changed. So let's close the loop. The signal that has preceded every modern gold bull run is the Fed pivoting to easing while inflation stays sticky. We've seen it 4 times. We've watched it deliver 24x, 7x, 8x, and 70% returns. It just fired again, stronger than at least 3 of the previous 4 runs. And it's firing on top of central bank buying, BRICS de-dollarization, and a $35 trillion debt load that the US cannot grow out of. Whether that translates to $5,000 gold, $10,000 gold, or $17,000 gold, nobody knows. But the historical record is clear about one thing. When this signal fires, gold moves, every single time. If you want to see the data behind this, including the specific report showing that central banks just hit 16 consecutive years of net buying, and why the next 18 months may matter more than the last 16 years combined, that video is on the screen right now. I'll see you in the next one.